Assalamu alaikum, dear students. Today we are going to start the third section of your chapter third, where you have to learn the different concepts of costs, the detailed analysis of short-run cost curves, various concepts of revenue, and the producer's equilibrium theory. Let us start with the cost concepts. What are costs? Dear students, let us explain it in this slide. Costs of production is the most important force governing the supply of a product, as we know that output needs inputs. When goods and services are produced, various expenses have to be incurred, example purchase of raw materials, payment to factors of production, etc. Broadly speaking, there are two important types of inputs. First, factor inputs, that is land, labor, capital, and entrepreneur, which are called factors of production. And second, non-factor inputs, such as raw materials. Thus, cost of production refers to the expenditure incurred by a producer or a firm on the factor as well as non-factor inputs for a given amount of output of a commodity. Or in other words, we can say that the sum total of expenses incurred by a firm on the factor as well as non-factor inputs plus the normal profit expected by the producer is called the cost of production. Now coming to the cost function. Dear students, cost function refers to the functional relationship between cost and output. The function shows how the cost of production of a firm changes with the change in output, and it is written as C is equal to F of Q, where C is cost of production, Q is quantity of output, and F describes the functional relationship between cost of production and quantity of output. Now the different concepts of costs. Dear students, it is necessary for the proper understanding of the price theory to know the various concepts of costs that are often employed. Firstly, let us discuss what are nominal and real costs. Dear students, nominal cost is the money cost of production. It's also called expenses of production, which are paid out by the producer in cash to the factors he employs or for the raw materials he uses in production. Such expenses also includes producer's normal profits, otherwise he cannot continue his business. On the other hand, the real cost of production or the costs expressed in other intangible factors in addition to cash, such as time, labor, lost opportunity, etc. The real cost of production has been interpreted differently by different economists. Adam Smith, the father of economics, regarded pain and sacrifices of labor as real cost of production. Marshall, that's Alfred Marshall, on the other hand, defined it as the pain and sacrifices of labor as well as the real cost of waiting. Some economists define real costs in terms of opportunity costs, but usually real cost is defined as the pain and sacrifices of labor involved in the process of production. Cost of production can also be classified as explicit and implicit costs. Explicit costs are the cash payments which the firm makes to other factor owners for purchasing or hiring the various factors. That is, such costs are the actual money expenditure or payments made to outsiders for hiring their factor services. For example, A firm has to pay wages to the labor he has employed. He has to pay interest on the capital that he has borrowed and rent of land or factory. These are called explicit costs. Explicit costs are also known as paid out costs. On the other hand, implicit costs are the costs of self-owned factors which are employed by the entrepreneur in his own business. That is, those are the costs which are not to be paid out to others or outsiders. Rather, they are costs of using resources or factors already owned by the producer himself. They are equal to what these resources or factors could earn in the next best alternative use. For example, a businessman utilizes his service in his own business, leaving his job as a manager in some other company. Thus, he forgoes his salary as a manager. This loss of salary becomes an implicit cost of his own business. Implicit costs are also known as imputed costs, which are important for the calculation of profit and loss account. Now, coming to another important concept, that is the accounting costs and economic costs. Students, accounting costs are the actual or explicit costs which are paid by the entrepreneur to the owners of hired factors and services. An accountant will take into account only those costs which involve cash payments to others by the entrepreneur of the firm. But an economist's point of view of cost is somewhat different. The economist takes into account all these accounting costs, but in addition, he also takes into account the amount of money the entrepreneur could have earned if he had invested his money and sold his own service and other factors in next best alternative uses. That is, economist takes into consideration both the explicit and implicit costs. Thus, economic costs not only include the explicit costs but also the implicit cost of the self-owned factors or resources which are used by the entrepreneur in his own business. Economic costs are thus equal to accounting costs plus implicit costs. Another important type of concept of cost is the opportunity cost, which are also known as transfer earnings. Dear students, the concept of opportunity cost is very fundamental to economics. It occupies a very important place in modern economic theory. The opportunity cost of any good is the next best alternative good that is sacrificed. Thus, the opportunity cost is the expected return from the next best alternative that is foregone or sacrificed. For example, a farmer who is producing wheat can also produce rice with the same factors. Therefore, the opportunity cost of a quintal of wheat is the amount of output of rice given up. Thus, simply, opportunity cost of anything is the next best alternative that could be produced instead by the same factors or by an equivalent group of factors costing the same amount of money. Now coming to private costs and social costs. Dear students, it is important to note the distinction made by the economists between the private cost and social cost. The sum of explicit and implicit costs incurred by a firm to produce a given amount of output constitutes his private costs. Or simply, private costs are the economic costs which are actually incurred by a firm to produce a product. It includes both explicit and implicit costs. It is these private costs that it takes into account while making decisions regarding price and output of the commodity that the firm produces. However, in addition to the private costs, the production of a commodity by a firm bestows some benefits or causes some damage or loss to others, which it does not take into account while taking decisions regarding price and output of the commodity. These external damages or benefits, if any, caused by the production of a firm to other firms or consumers, constitute a part of the social cost, which are usually ignored by a firm, but they may be of great significance from the social point of view. Let us give an example here. A firm producing pesticides pay prices for the purchase of raw materials, for the purchase of labor and capital used by it. These are the private costs of the firm. But in the production process of pesticides, some byproducts such as false smell, polluted air and effluents that are emitted along the production of pesticides cause damage or costs to other people who live in the adjoining areas. These harmful external effects are also called negative externalities. The beneficial external effects created by firm are called positive externalities. The social costs are the sum of private costs and the net of negative externalities or positive externalities. If social welfare is to be maximized, it is the social cost and not the private cost alone that has to be minimized. Thus, simply social cost implies the cost which a society bears as a result of production of a commodity. Social cost includes both private cost and external costs. Now coming to fixed costs and variable costs. Dear students, fixed costs are the expenditure incurred on the factors which remain fixed in the short run, such as capital, land, factory building, etc. And such costs cannot change in the short run. Therefore, fixed costs are independent of output in the short run. That is, they do not vary with the level of output in the short run time period. Even if no output is produced in the short run, fixed costs will have to be incurred by a firm. On the other hand, variable costs are costs incurred by the firm on the employment of variable factors such as labor, raw materials, etc., whose amount can be easily increased or decreased in the short run. Variable costs vary with the level of output. If the firm decides not to produce any level of output, variable costs will not be incurred. Now coming to total, average and marginal costs. Dear students, total cost is the total expenditure incurred in the production of goods and services, or in other words, we can define it as the total outlays of money expenditure, both explicit and implicit, on the resources used to produce a given output. Total cost is equal to total variable cost plus total fixed cost. Average cost is the cost per unit of output which is obtained by dividing the total cost by the total output. Thus, average cost is equal to total cost divided by total output, or TC divided by Q. And lastly, marginal cost is the addition made to the total cost as a result of producing one additional unit of the product, or simply it refers to the addition to total cost when one more unit of output is produced. Dear students, the detailed analysis of the total cost, average cost, and marginal cost, and also the analysis of short run cost curves will be given in our next lecture. Thank you.